nobody loves paying taxes. And the reason to purchase real estate, one of the main reasons is the tax efficiency. And 1031 exchanges are one of the things that really, really make investing in real estate tax efficient. The problem with 1031 exchanges is that they're very confusing. They're convoluted. There's a lot of moving parts. I thought, until I watched and listened to this interview that I did with Kent Tharp at Iowa Equity Exchange, and he explained everything in a great detail in a very good way. So if you are interested in 1031 exchanges on a very elementary but still deep way to understand them, listen to this interview. Here we go. Okay, Ken, appreciate you joining. Yes, thank you so much. It's good to see you in person. I've emailed you and your son back and forth a little bit on different clients that have done 1031 exchanges. But so I wanted to have you on just because tax preparation planning is key in real estate. You know this. We don't have to explain why, but help us understand kind of your vision on, or what your company does, I guess you could say, and how long you've been doing it. Just a real quick, 2 to 3 minute just synopsis.
You bet. Well, thanks, Darson, for having us in the first place. We sure appreciate that. I'm going to give you about a 15-second bio here. I've been in real estate in the Des Moines area since 1978. I've done all kinds of different things. 15 years ago, I started Iowa Equity Exchange, which is a company that deals exclusively in Section 1031 exchange work. Section 1031 is a part of the Internal Revenue Code that allows investors or business owners to sell property, reinvest the proceeds in other property, and defer their taxes. The best analogy that's available is an IRA rollover. Lots of people are familiar with that, where they've got money in an IRA at one particular location. They see something else they want to do with their money, and they can do that. They can move their money from location A to location B, but it has to be done a certain way, or you trigger taxes. This is a very similar thing. Do you want me to just roll here for a while, or?
Yep. Yeah. Let's go. Yeah. So explaining that, let's go into the 101 of how it's done. Yeah. Let's just go to the how.
Okay. I'm going to go to the why.
Okay.
There. Well, yep. We can talk a little bit about how, but how is not, I don't think, quite as important as why. Okay. And I guess this is also how, but the important thing to remember is this only applies to investment properties or business properties, properties that are used in one's business. There are only extremely limited situations where personal residence comes into play, and that is only probably the best example would be a farm, where a farmer lives on the land that he farms. He can exchange out of that, but he has to kind of segregate the residence portion of it, because residences are not allowed in 1031 exchanges. There's better treatment for residences anyway than Section 1031. And I don't know if I'm giving away trade secrets here, but you guys emailed me a list of questions that had come in, and I kind of pulled from that a little bit and just wanted to address several different things that kind of will answer maybe a number of questions all at once. It's critical in an exchange. Well, critical is the right word. You can't do an exchange any other way. The taxpayer needs to be the same on both sides of the exchange. So the taxpayer who sells the property that's being given up has to be the same taxpayer that takes title to the new property that's being purchased. There were several questions about things dealing with other than real estate, and those are easy questions to answer, because as of beginning of 2018, Congress limited Section 1031 to real estate only. So you can only exchange real estate, and you have to buy only real estate. So that makes it pretty simple. We had questions about buying a boat. Just can't do it. It's not available anymore. Investment boats are pretty hard to find anyway, but I suppose it could have been. We used to do aircraft exchanges for exchange. We did, or for example, we did a whole lot of road graders and those kinds of heavy construction equipment. You just can't do that anymore. It's real estate only, and it's real estate for real estate. Got to sell real estate and buy real estate.
Well, just to backtrack on that, road graders, I feel, where's the equity? Like, where's the gain on that? They went up in value. Is that the reason?
No, and again, it has nothing to do with real estate, what we're talking about now. But when you buy a road grader or something like that, you can depreciate it really quickly. And so it gets down to zero. And when that goes in as a trade-in or when it gets sold, that's income to that business. And so we used to do exchanges so people could, or so companies would avoid paying income taxes on that, whatever they were able to get out of their road grader or whatever. So yeah, that's a good question.
So that sounds a lot like a cost segregation property, right? Is that the same situation and use the same process?
Yeah, pretty much. There was a cost segregation question that you sent me. Maybe it was your question, but
it was not.
Okay.
Yeah.
And I was kind of going to set that one aside, but since you bring it up, let's talk about it a little bit. We have not really gotten into a lot of exchanges that have involved cost seg studies, but our understanding of things is that it's kind of like depreciate. Well, it is depreciation. It's kind of like depreciation in that depreciation is a really good thing while you own the property, but it's not so good when you go to sell the property because you recapture that depreciation. With the cost segregation, you're going to recapture even more depreciation. And in some cases, there isn't any depreciation left. And you're probably in that same situation where when you sell your sidewalk that you've been able to depreciate real quick, you're going to recapture it as ordinary income. Now, if you go into another property that has some of those same things and they're directly attributable to each other, so sidewalk for sidewalk, you probably can transfer your zero basis in your old sidewalk to your zero basis in your new sidewalk, and roof and on and on and on and so forth. It gets pretty technical, and we're getting pretty deep in the weeds here right off the bat, where we don't really even know what we're talking about almost at this point. But and as I said, we haven't really gotten into people that have had those cost segregation studies done on their property, unless they were done and they didn't tell us about it, and it's all going to be handled on the accounting side of things, which it very well may have been. I mean, we've dealt in some pretty big stuff. So it's really likely that we have had clients that have had cost seg studies done.
Yeah, I was going to say, I bet so too. I bet it just hasn't come across your plate because it's probably really tough to do that true one-for-one transfer.
Right. And that's kind of beyond our scope of what we do. And that gets us back to what we do. So let's talk about that for a bit. Basically, we're going to handle everything that's needed to accomplish the exchange. So a client comes to us and may come directly, may come through a referral. You may have found us on the internet. We get a lot of that. So we talk with them about what their goals are, what their plans are, make sure that what they want to do is something they can do. And I'll be honest, we talk a lot of people out of trying to do exchanges because they just have unrealistic goals, or they want to just do something that can't be done. But
can you give me a couple examples of the unrealistic goals? I understand the can't be done thing sometimes, but what's an unrealistic goal that you hear a lot?
Well, we have a client we're talking with, or a potential client we're talking with right now, who owns property in the name of an LLC, and they want to buy property in a different taxpayer name. Well, again, this can't do it. It's unrealistic. This came up on the questions too. Own property in an LLC with several other people, and some of those people want to exchange and others don't. There are ways to get that done, but the further away you are from closing, the easier it is to do those things. So come to us today, say, I've got an LLC with 3 other partners, 2 of us want to exchange, 2 of us don't, but we've got a deal to sell our property, but we've got a flexible buyer who can wait 6 months. Well, we can probably handle that because we can get the property out of the name of the LLC, distribute it to the partners individually as undivided interests, and then they can each individually decide to exchange or not exchange. But if you do it right before closing, it's a red flag to the IRS, and it may or may not fly. So we just try and let people know about the risks, and then urge them to talk to their tax advisor, and we'll talk to their tax advisor too and discuss the whole situation, just to see if the tax advisor is comfortable with doing this, because we always tell people, we're not going to sit across the table from the IRS. It's the tax person that's got to do that. So we want to be sure they're on board.
Oh, that's good. That explanation of the LLC and the different owners, I've always just generally heard you can't do it when you own something with other owners. But what you're saying is if you just plan far enough in advance, you know that you actually can do it legally. So that's good.
Yeah. And again, the more time that passes between that distribution out of the LLC to undivided interest, the better, the safer. Ideally, right. You do it in, let's say you did it in 2021, you let all of 2022 pass and you sold your property in 2023. Well, I don't think there'd be any problem with that. You start condensing that, and the less time you get there, the redder the flag is.
So so you mentioned red flag. Does the accountant bring up the red flag? Is that typically what happens? Or is it, if audited, that's going to be the red flag? Like, where's that? And I know it's tough to say, where's that risk?
Well, again, if we know about this in advance, we're going to talk to the client and find out what their plans are and what they're going to do, but and throw the red flag up ourselves, discuss it with the tax person. I told you I'd been in real estate a long time. Early on, I went to a seminar, and I still remember this guy standing up in front of the room saying, if you put it on your tax return and you don't get audited, then you did it right. But that's not a real great plan, but that's kind of what this comes down to, is it's going to be on your tax return, because Form 8824 is the form that's used to report an exchange. And on that form, you have to declare the date you acquired the property that you're exchanging. So if you distribute the property out of the LLC to Joe, Ed, Dick, and Harry on January 2nd, and you close on your sale of the property on January 5th, the IRS looks at that and they say, oh, you owned it 3 days. Well, how do you demonstrate that you held it as an investment in a 3-day period? You just can't do that. So there's the red flag. Then it's going to be a bright red flag in a situation like that. Now, I just said something that I haven't talked about yet. So can I tell you, can I fill you in on that? I said, the IRS is going to say, how do you demonstrate that you've owned it, held it for investment or business use? And that's a core factor within Section 1031. It's based on the notion that the IRS says that if you sell property that you have held for productive use in a business or trade or for investment, and you exchange that property for other property that you would intend to hold for productive use in a business or a trade or for investment, then you will not have to recognize your gain from that sale, meaning pay taxes on the gain. So you need to be able to demonstrate one of those uses. How do you do that? Well, in case of an investment, if you rent it out, you've reported rental income. you've done the things, insured the property as a rental property and those kinds of things, then that's how some of the ways that you can demonstrate that you've held it as an investment. If you just acquire it, in my example where you distribute it out of the LLC, it's pretty hard to demonstrate investment intent. And so if you get audited, there's a pretty fair chance they're going to disallow the exchange or at least question you pretty hard about it.
Gotcha.
And it's just those kinds of exchanges where you start as an LLC and you distribute out, we call those drop-in swaps. You're going to drop the ownership and then you're going to swap the property or exchange the property. Drop-in swaps are somewhat more likely to be accepted today than they were 5 years ago. There have been some private letter rulings that apply only to the person that asked for the private letter ruling, but still there have been several of them, and the IRS has allowed things that maybe we wouldn't have thought would have been allowed 5 years ago. But still, there's a risk. So anyway.
So when you said like a like business or held for business use, one thing that came to my mind was people that flip houses, and right, because that's a big chunk of money. From what I've always heard is you cannot do that. You can't do 1031 exchanges with flip houses. What is to me, that's a business use, flipping houses, right? And it's a business, but the IRS doesn't think of it like that.
There's a distinction there, and it's pretty fine. But the idea of business use means you've bought a property and used it for business use. So you own a plumbing business and you buy an office warehouse kind of property, use it in your business. Now you need a bigger one, so you're going to sell that one and exchange into the bigger one. So that's business use. But using property that you buy in your business of selling property, that's something that they don't go for. Yeah.
That'd be like, because the real estate, that the building is like a widget.
Yeah.
And so,
right.
Okay.
Exactly.
That makes sense.
Exactly right.
Okay.
Yeah.
Thanks for helping me think through that.
You bet.
Okay, cool. So we've kind of been in the weeds. Is there anything you want to touch on besides just going into like 101? We've kind of talked about why, maybe into the how now of just time frames of everything. We kind of talked about the time frame of the LLC.
Yeah, you bet. Let's go through the how in a short period here, and I don't know if we'll have some questions here from people in the audience or what, but
yeah, that'll be next.
So to start an exchange, one critical factor to take out of this conversation is that your exchange has to be in place prior to your closing. So we're talking about regular exchanges where you sell first, then you buy another property. So before that sale closing, you have to have your exchange paperwork in place. You have to be in contact with your qualified intermediary, which is what we are. And your qualified intermediary is going to prepare a set of exchange documents, get those to you, you sign them, send them back to the QI, and the QI then has to take some time and work with whoever's doing the closing of that transaction to be sure that the closing's handled correctly and that the closing agent knows where to wire the money, which it means to us. That's a huge part of what we do is we keep the client from touching their money. Back to the IRA rollover thing. If you sell your IRA and the money comes to you and you reinvest it in a new IRA, well, that's taxable because you've touched your money. You have to have that money go directly from investment house A to investment house B. Same thing applies here in real estate exchanges. The money has to come to your QI. Your QI holds it until you're ready to buy the new property. We coordinate with that closing agent, find out where to wire the money, review the documents, and make sure they're in order before the closing, and then wire that money in, and then you close on that property that you're buying, and you've got a completed exchange. Now, that's it in a nutshell, but let's talk about time frames. So no time, no clock starts on your exchange until that first closing. That's when the clock starts, and there are two clocks, two deadlines. The longer of the two is the whole exchange period. You've got a 180 days from start to finish to get everything done. Calendar days, yeah, to close on your new property. So you close on your sale property, that starts the clock. You've got 180 days, just shy of 6 months. Why they chose calendar days, I don't know, but they did. So, so you've got 180 calendar days to get that second property closed. And while we're talking about the second property, you can have multiple properties in one exchange on either side. So you can sell multiples, buy multiples, but it all has to happen within 180 days of that very first closing. Now, within the 180 days, the shorter clock is called the identification deadline, and that's 45 calendar days. And if there's something that's going to trip you up in your exchange, this is probably it. By the end of the 45th day after that first closing, you have to identify potential replacement properties, potential properties that you want to buy. We'll talk about how to identify here in just a second. But once that 45th day passes and you've submitted that list of properties, that's it. You can only buy from that list. And so, especially in a market like we're in today, where it's a strong seller's market, most places, if not all places, you really want to know what you're doing by day 45. And if at all possible, you want to have one or more of those properties under contract, and you're just proceeding then to closing so that somebody else can't come in and buy it. Because if it sells to somebody else and you go past day 45, you can't substitute. You're just locked into that list of properties. Now, the list of properties, there are limits on how much you can identify. I suppose this came about because at one time people just said, well, I'll buy whatever I can buy in the United States. So that was pretty wide open. So they decided to limit it. Now, where they came up with the rules, I can't really explain. And I sometimes say I feel like a kindergarten teacher when I'm explaining these rules because they seem pretty arbitrary. But the first one is your limit is 3 properties. That's it. You don't have any other limits. So just don't identify more than 3. And then you can go ahead and buy one of them, 2 of them, or all 3 of them in your exchange if you want to. Now, if for some reason you want to identify more than 3, you can do that. And we have people do this from time to time. It's not a real frequent thing. And when it happens is almost always because somebody sold a big property, meaning expensive, and they want to buy a number of smaller properties, more than 3. So you can identify more than 3. In fact, you don't have any limit as far as how many you can identify now, but now you have a valuation limitation. And so your limit now is that you can only identify up to 2 times the fair market value of the property that you sold. So let's say you sell a property for $1 million. You can identify any number of properties whose total fair market value does not exceed $2 million. So you could combined. Right. You could identify 10 $200,000 properties, let's say, and you could buy 5 of them. Well, you'd want to buy more than 5 if you sold for $1 million. But and that kind of leads us into another little thing here. People often ask us, what do I have to do to defer all my taxes? And there's a pretty easy answer to that. It really boils down to 3 things. Let's back up. Do you have any questions about those deadlines, Darson? Or
No, that was good. I was going to ask on the valuation side of things. So yeah, go ahead, dive right into that. Take a drink and then dive right into that.
Okay. All right. Well, I lost my train of thought. We were talking about value. Go ahead.
Yep. Yeah, no, just about the valuations of the size of the property.
Yeah,
How do you make sure
taxes.
if you want to be zero taxes, right, or leave some into the deal, and you might have to pay a little bit of taxes, which no one
But
wants to
sometimes
do.
people do. There can be good reasons. So to defer all of your taxes, let's talk about that for starters, and then what happens if you don't do that. The first one is you have to buy property that's equal to or greater than the value of the property you've sold. And we go by net sale price. Now, we don't calculate a net sale price, but we can kind of ballpark a net sale price. The easy way to ballpark a net sale price is take the gross sale price. So your sale price on your contract is $500,000, let's say. Take that, and if you're paying a real estate commission, take that off of the $500,000. So let's say 5% off of that, $25,000. Now we're down to $475,000. Take another $5,000. And that's just a shot in the dark pretty much. But, it could be 3,000, could be 7,000, who knows. But that gets us down to 470. So net sale price of the $500,000 sale might be around 470 somewhere. If you want to be safe, just take the commission off and forget the other things. The commission can be taken off. The other things, sometimes there's a little question on them. And so you have to buy that much worth of property to defer all of your taxes. Now, if we just stop right there, you're going to do everything you need to do to defer all of your taxes. There are a couple of other things we like to say, but again, if you make that $475,000 purchase, you're pretty much forced into doing the other two things. One is use all of the proceeds, so don't end up with any cash. Any cash that you take out of the deal on either side of the transaction is going to be taxable. You can't pull cash out for any reason and have it not be taxable. Okay, here's the one that's hard for people to understand. You also can't be relieved of debt that isn't replaced on the new property. So your $500,000 deal, let's say you owe $300,000 on that property. On the new property, you either have to borrow $300,000 or more, or you have to throw in $300,000 cash out of your pocket. You can do that, or you can do part of, some debt, some cash. One way or another, though, you've got to have that $300,000 in. And I go back to saying, if you just buy something for $475 in our example, you're forced into doing all those things, pretty much. Okay. So if you don't do those things, you're going to have to declare some gain and probably pay taxes, depending on everything else that goes into your tax return, which we would have no way of knowing.
Right. Wow, the debt thing. I knew that, but I didn't know what that number was. So it can't relieve debt, essentially, without you some of your own money.
People come to us and say, well, I put $50,000 down when I bought this property. I'm going to just take that back out. It's just my initial investment. Well, you can take it out, but you're going to be taxed on it because the IRS doesn't look at that as your original investment. They look at it as part of the capital gain. So you can't do that. And pulling debt out, the concept that I use to explain that is, we know that if you go to closing, the closer is going to pay your debt off. But the concept is, it's like the closer gave you the money and said, here's $300,000, take this to your bank and pay your debt off. So it's the same as receiving that cash.
So I'm just trying to think of and this is more maybe of a banker question than your question, but help me understand why you couldn't just have the debt, like a $300,000 on the new, $500,000+ purchase, and then you just refinance that out and get that cash back out, right? I mean, you could do that.
Yeah, you brought something up there that can be done. You can refinance after you purchase. Yeah. You don't want to refinance right before you sell. You don't want to do that because now you're relieved of debt that you no longer have to pay. Okay. So, all right, let's say I own this $500,000 property. I've got $100,000 in debt on it, and I refinance it and get $300,000. Well, get $200,000 in excess. Now I owe $300,000, and I sell it. That debt has to be paid off, and I'm relieved of it, and I don't have to repay it. I don't have to pay it anymore because it's paid off. So the IRS would look at that and say, I got $200,000 tax-free that I'm no longer liable for. So this gets a little weird too, but just remember those things. You shouldn't refinance right before you sell in an exchange, but after you buy in an exchange, now you're on the hook for the new debt. So you can refinance at that point and pull tax-free cash out that way. Keep in mind, though, that when you do that, we haven't talked about tax basis at all in this conversation yet, but that doesn't change your tax basis. You still have a lower tax basis in that new property, and now you've got a big amount of debt, perhaps, and when you go to sell, you can be in the position where if you sell and you don't exchange, you don't even have enough proceeds to pay your capital gain tax. So,
yeah, because you cash out refinance. Yeah.
Right.
Yep. No, that's good. I mean, it's just it's planning, right? That's what everything I keep thinking is like it's just planning and thinking ahead and playing chess instead of checkers.
Yeah.
Okay. So do you anything to add on that?
I don't think so.
One of my next questions would be when 1031 exchanges fail, so they fall apart, what does that look like? And obviously it's probably multiple reasons, multiple ways. What does the client have to, what happens?
Okay. Well, it's really very simple. They're out part of a fee to us because they've paid us part of our fee, most of our fee at that point. But other than that, now they just report a sale. I mean, they just sold their property. They didn't exchange anything. There's no penalty for starting an exchange. There's no reporting to the IRS. They wouldn't know that you started an exchange because you're not going to report it. So it just failed. You paid a bit of a fee to us. You gave it a try. It didn't work out. And so now you report the sale.
Okay.
And deal
Simple
with it.
enough.
Yeah.
Deal with the accountant and the CPA of how to handle those taxes of that.
Right. Yep.
Situation. Okay. Let's see here. We had one question in there about furnishings. So Airbnb is probably a world that's new in the 1031 exchange world because you could argue that is more maybe like a business.
Yeah.
And how that works, right? And the furnishings that come along with that, I'll just stop there. Have you had any?
Yeah, that's pretty simple too, because they're just not real estate. You know, there's an allowance for certain things. Like when you buy an apartment building, the appliances aren't real estate either, but they're a functional part of the real estate. And so the IRS allows for incidental expenses up to 15% of the total. So sell for or buy something for $1 million. If you're acquiring appliances that are worth no more than $150,000 in your apartment building, you should be okay with that. Which most apartment buildings that sell for $1 million aren't going to have $150,000 worth of appliances. Same with the Airbnb or VRBO property. Although, here's the difference. You'd want to be buying a furnished house, and the furnishings and so forth were in the house already. And even then, that's something we'd sure send them to their accountant and say, make sure your accountant's okay with this, that you're including these things in the purchase price. My wife and I have a VRBO property, and we I don't think we've ever, there's a lot of advantages to buying those things outside of the exchange too, because once again, you can just write them off in the year you buy them.
Yep.
So maybe that makes more sense than including them in the purchase.
Right. Multiple options, multiple things to think.
Right.
How about reverse 1031? So you said like a traditional 1031 exchange. How about the reverse where you weren't able to identify the 3 properties at the time of closing? What does that look like?
Well, it's not exactly what you just described. So you can tell I talk with my hands a lot. When I do presentations in front of people, when I start talking about reverse exchanges, I put my hand up and I show the 4 fingers here. The rules for reverse exchanges apply. Well, before I do the 4 fingers thing, rules for reverse exchanges also apply to construction exchanges and improvement exchanges, where we're starting from bare dirt and building something, or where we're starting with an apartment house with a flat roof and they want to put a pitched roof on it, for example. We had a couple of those over the years. So all the rules that have to do with reverse exchanges apply to all those things. So now I'll do the 4 things. So in all the exchanges we've talked about thus far, there have been 4 parties to the exchange, the qualified intermediary and the client in the middle of things. And then there's been a buyer of the relinquished property, the property that's been sold, and a seller of the replacement property, the one that they're going to buy. Now, in these types of exchanges, we add a 5th entity, and that entity is known as the exchange accommodation title holder. Now, what's that mean? Well, in any one of these exchanges, the issue that we need to overcome is that the client wants or needs to control I'll use the word own for now, own both properties at the same time. So in a reverse exchange in a nutshell is you want to buy your new property before you sell your old property. And if you buy it, you own it and you own the old property at the same time. No exchange. You can't do an exchange at that point. So exchange accommodation title holder, we're going to take title to that new property for our client and hold title until their old property sells. So that's a reverse exchange in a nutshell. In a construction or an improvement exchange, those can happen and start out as a reverse exchange, but more often than not, they start in a regular type of exchange where they sell first, and then they want to buy something and build on it or improve it. And so again, once they close on that new property, they own both properties. We can't use exchange money for the improvements or the construction. So we have to postpone them taking title, and we do that again with the exchange accommodation title holder that takes title for them and holds that new property while they're constructing it or while they're improving it. And all those improvements and all the costs and so forth have to flow through the EAT. So it gets pretty complicated, pretty technical here. But we do a lot of these, especially now. I think we're doing more reverses than we have in the past because especially as you get into the higher dollar things, people don't want to start their exchange without knowing they're going to have something they can buy, and they don't want to go out and settle for something that they bought just kind of as a stopgap. So they go out and find something to buy, and they get it under contract, and the seller wants to close and won't sell if he can't close on June 15th or whatever it is. And so we do a reverse exchange on it. And then our client still has a seller's market to sell his property in. So reverse exchanges do fail too, but they don't fail very often.
Yeah. Okay. No, that's really good. Cool. What else? I'm trying to think of what else in there. How about Delaware Statutory Trust?
Yeah.
Right.
Yeah.
Help me understand. And what do you guys have to do with that? Where do those fit in, or do they?
Well, they do. And the question in here, I wasn't sure if that was what the question was referring to, but I kind of thought it was. So Delaware Statutory Trust is a kind of joint ownership with a large group of people where there's one big entity up front that's the sponsor, that they've acquired this property and they've got 50% debt on it, let's say, and the other 50% they've got in it already themselves, and now they're selling interests in that property to investors. And that's where the Delaware Statutory Trust comes in. They've set up a Delaware Statutory Trust so that they can sell interests in that property. Now, we've talked about you have to buy real estate. You can't buy interests in an LLC, for example. That's not something you can buy in an exchange. You have to buy real estate. So how can they do that? Well, that's the whole mechanism of the Delaware Statutory Trust. They're set up so they can buy, so that they can sell fractional interests in that property. So our client might end up buying a 0.36952% interest in that new property for their $200,000 investment or whatever it might be. So they own just a tiny, tiny bit of an Amazon warehouse, for example. And it's a completely hands-off investment for them. They don't have any control. They give up all the control. They're going to get, in all likelihood, a lower rate of return than what they would get if they were managing it themselves and the way they used to do things, probably. But there's a lot of advantages for it. There can be estate planning advantages where you own individual properties. It's hard kind of to pass that on to the heirs, but if you own these fractional interests, then they can get it split up pretty easily. So that, I guess, that's a pretty, again, a nutshell version of the whole thing. But
yeah, no, I didn't understand. I was curious about that. I didn't understand that, but it's something that's already set up. You as the investor are not setting up the Delaware Statutory Trust. You're really buying into a mutual fund-ish of real estate,
right,
for lack of my terminology.
Yeah, no, that's basically right. And you work through a financial advisor, and there aren't too many financial advisors around that are familiar with DSTs. I was going to say even know about them, but there aren't too many that are very familiar with them. We've got a core 3 or 4 guys here in the Des Moines area that we work with, and then there's some other people around the country that we've worked with too. A guy in Omaha and a guy in somewhere in Colorado. I can't think where from right now, but anyway, so yeah, we can refer people to those people if they're interested in that. It's a really nice investment in certain situations, and in other situations you wouldn't even want to think about it, just because you can tell I've got a few years on me, and I told you already I've been in real estate for 44 years, so I'm I've been around for a bit, but I still have that urge to control my investment. It's hard to let it go.
Yeah, I would agree. Okay, so we kind of I posted in there to ask for a Q&A of anyone that has any questions. One question: what weird things count for real estate for an exchange? Timber, long-term leases, O&G interests, oil and gas.
Yeah. Well, all those things can. The timber can't be harvested. It has to be attached to the real estate, so still growing. What was the second one?
Long-term leases, maybe net, like triple net stuff.
Well, triple net things certainly work, yeah, but you're buying the real estate. You're not buying the lease. There can be situations where there can be a long-term lease. Let's say a ground lease under a McDonald's or something like that. Somebody owns the ground under that McDonald's, and it's got the threshold is 30 years. So it's got to be 30 plus years for that lease to constitute real estate, to be real estate. So Joe Smith that has a McDonald's lease can sell, or I'm sorry, McDonald's ground lease can sell that ground lease if it's got more than 30 years, and that includes options. So it could be a 20-year lease with 3 5-year options, let's say. That gets it over 30 years. And you can buy that sort of thing, too, as your replacement property. And then oil and gas, a lot of oil and gas leases can also work. We don't get into that much, but we've had a few people that have bought those as replacement property.
Yeah. And just to be clear, you are Iowa Equity Exchange, but it doesn't have to be an Iowa purchase, right?
Yeah, I'm glad you said that. We can work anywhere in the United States, basically, and do. It's really, after 15 years, I'm amazed the reach that we have. We have stuff all over the place, and 9 times out of 10, there's some Iowa connection, but we do stuff that has no Iowa connection too, a pretty fair amount of it. Maybe I shouldn't have chosen Iowa Equity Exchange. Maybe I should have chosen Jordan Creek Equity Exchange, or I don't know what, but
you never know, right? Like it's tough to look back and maybe people have chosen you because it is Iowa, right?
I think there's a lot of that too. People trust people from Iowa. So I think maybe people have a tendency to believe we're not going to run off with their money, which we don't,
Yeah, you're not in jail.
Not in jail. That's right.
Okay, so a couple of questions. Do the fees change depending on the type of exchange, or what impacts it? The fees.
Yeah.
And you don't have to air like exactly unless you want to, but just ranges would be great.
Yeah, I'll give you some ranges. Yes, the fees do change. The reverse type of exchanges where we're using the exchange accommodation title holder are quite a bit more than a regular exchange. So for a professional company like ours that does this day in and day out, takes it very seriously, I'll say belongs to the Federation of Exchange Accommodators, which we do. I actually joined that organization before I even opened Iowa Equity Exchange to develop some contacts so that I could ask questions to people and that sort of thing. Now occasionally we get questions after 15 years, but the companies that take it seriously, I would say their prices for a regular type of exchange would range from over $1,000 for sure, up to a couple $1,000s probably. We're in that range. We're probably a little bit toward the low end of the center of that range. For reverse exchanges, things go up quite a bit. Reverse in any of these construction and improvement type exchanges, you're looking at probably on the low end. I don't know if you could get it done for $5,000 or not, maybe someplace. And then probably upwards to $7,000 or $8,000. And again, we're probably on the low end of the middle of that for ours. Beware of add-ons when you talk to people. There are attorneys that do exchanges and they'll quote low fees, and then they're not trying to deceive anybody. I don't want to indicate that that's the case, but they'll quote a low fee, which that's their fee. But then, generally speaking, an attorney can't do an exchange. Well, not generally speaking. Specifically speaking, an attorney cannot do an exchange for his client. That's we haven't talked about that yet, but I tell people that the term qualified intermediary kind of connotates that you have qualified to do something, right? But that's not really the case. What's really the case is we're not disqualified. So there are a lot of people that are disqualified from serving as a qualified intermediary. Your attorney, your accountant, your real estate broker or agent, your financial advisor, your close relative, all those people are disqualified from acting as your qualified intermediary in an exchange. And so that means everybody else is qualified, including us. But that's it. So you have to be careful about how you choose your intermediary. You want to choose somebody that does it professionally, in my opinion, and you also want to choose somebody that's a member of the FEA, the Federation of Exchange Accommodators, because those people take it seriously, and it's a great organization. So and they keep us informed on what changes are made across the country, because every now and then there will be a state change, and we want to know about that because we may be working in Ohio next week for something.
Right. Okay. Anything else on that? Sorry.
Well, I think I got off track. I'm not sure I answered your initial question.
No, it was good. It was just rate ranges, right? In the
rate ranges.
Yeah, you did great. That's exactly.
Oh,
yeah.
The only other thing I wanted to say was the attorney who quotes you a fee that's lower than ours, let's say, there may be a fee from the bank. There probably is a fee from the bank because he's going to enlist a bank to be the qualified intermediary since he can't do it. By the time you pay those two fees, you're up in our range, and they don't do it every day, and we do.
Yeah.
So
yeah,
there's my argument in favor of a professional.
No, that's good. That's just good, good vetting, right, of just the process in general and what to look out for, because you can Google anything and find someone to do it. But there's, yeah, I get it. In any industry.
Yeah, right.
Talk about recapturing depreciation on the sale. Do we pay that? Or is it also part of the exchange?
Yeah, I should have mentioned that, but that's a great question. If you do what we said to defer all of your taxes, you're not only deferring your federal capital gain, you're deferring any state capital gain, and you're deferring all your depreciation recapture on the real property for sure. It's the other stuff that you may not be able to defer, but hopefully there isn't very much of that. So yeah, you get to defer all that. And, we'll look at things kind of in a ballpark sense. And if we talk to our client and our client gives us enough information and we can kind of ballpark what their gain is going to be, we can also kind of ballpark what their rate might be when you combine all those things, federal, state, and depreciation recapture. And it's usually in the 30% range. 28, 30, 33% of the gain. And the thing people don't understand or don't realize oftentimes is what their gain is. Their gain is the difference between what they sell for and their tax basis. And we talked about tax basis just real quickly there for a minute. But your tax basis is what you paid for the property plus any capital improvements. Those are big things like a roof or a furnace or something, siding, windows, those kinds of things. So that gets added on to what you paid for it, but then minus your depreciation that you've been entitled to take over the years. So if you paid $100,000 for a property and you've owned it for 15 years, your basis is likely to be down in the 50,000 range, maybe something like that. And you sell that for 250,000, you've got a $200,000 gain that you're going to pay 30% on, $60,000 maybe. So now you've only got $140,000, and that's why we do exchanges.
Yeah,
that's why people exchange, because you can use that whole $200,000 and not have to send part of it to Uncle Sam,
right,
and the other people, the state, and so forth.
Different uncle.
Mm-hmm.
Okay, so
yeah, it's an aunt right now.
Yeah,
Aunt Kim. In Iowa.
That's funny. I haven't heard that. Good. Okay, so we've been talking for just under an hour. I told you this would be 20, 25, 30 minutes. You told me probably not going to happen. So I apologize. Thank you. One more, where was I going at with that? Oh, legislation of 1031 exchanges. Yeah. I mean, real quick, is there anything that anyone, I hate to say, can do about it? Or what is your advice for investors when they're worried about the current legislation and where 1031s are at?
Yeah, it's actually the very last thing on my notes that I wanted to talk about too. So I'm glad you brought it up, Darson. 15 years ago when I started Iowa Equity Exchange, I was concerned about this. And I talked to some of these QIs around the country and said, what do you think's going to happen? And they said, well, it's been under attack for a long time and it hasn't changed. And so we don't know what's going to happen. Nobody can guarantee what's going to happen, but we think it's going to be around. And, we encourage you to go ahead and give it a shot. So I did. I'm obviously very happy that I did. It's been a tremendous business to be in. Met a whole ton of people, but anyway, that's another story. So where do we stand right now? Well, when our present president came into office, his part of his deal was he wanted to not eliminate 1031 exchanges, but kind of cap them. And the way he was going to cap them really would have been an elimination, more or less. I mean, it would have been terrible. The FEA that I've talked about many times now in this conversation has a really active legislative lobbying group that we work with, and we're such a small organization that we can't bring about change on our own. So what we do is we partner with like the National Association of Realtors, farm groups, all kinds of different groups that are involved in real estate, and lobby Congress people about this. And we're fortunate in there are a lot of Congress people and senators who are well versed in this. There are a lot that aren't, but there are quite a few that are. And those people are typically on our side. They're typically very supportive. They typically go out and help us communicate our message to the others. So I can't tell you what's going to happen. And there's a current budget right now where Biden has, I said that word.
Budget or
has proposed the same thing, the same exact cap in his next year's budget. And so we're going to go in for round 2 on this. And it's not round 2 for the overall thing. It's like round, I don't know how many, 30 or 40 or whatever. So it's a constant fight. But we don't expect that it's going to be retroactive, although, again, you can't promise anything. It'd be pretty terrible to do that to people that start an exchange and then change the law and they say retroactively you can't do it. I mean, that doesn't happen very often in our country. But so anyway, no guarantees, but I'm pretty confident. I'm confident enough that my 2 kids work for me, and we're gradually changing things so that they're going to be the boss.
Good for you.
And I'll be the guy that hangs around at the fringes.
You'll be drinking coffee.
Yeah, right.
Why is a legislation happening? What's the purpose, pro and con?
Oh, okay. That's a good question. Well, it's happening because they either truly think they can raise more taxes by disallowing exchanges, or they think they can make it look like they're raising more taxes by disallowing 1031 exchanges, and they think they're going after the big guy, and they want to get the votes of the little guy and all that kind of thing, like we see all the time. The FEA has commissioned a couple of different studies. Ernst & Young did one of them, and then there's another organization that probably nobody's ever heard of that did one that talked about the cumulative effect and how when you take away commercial transactions especially, but even residential transactions that have to do with investment property, how that filters down. So you take those transactions that would no longer happen, because if you can't sell your property and exchange into another property, a lot of people are just going to keep that property. So now you don't have a closing, so the closers have less work. You don't do title work, so the title companies don't have work. The lawyers don't have work. The roofer that needs to replace the roof doesn't have work. You can just go right on down to the little people that they claim to be helping. And so that's why it's important, in addition to preserving the right for investors to do the exchanges, that's why it's important to preserve exchanging. Now, what can you do about it? Well, as a single person, you can't do a whole lot. But again, cumulative, if you take the time to write a letter to the IRS, while we're talking here, I'm going to load this up here. I hope I can do it quickly and give you this link. Write a letter to your Congress people about it.
Me afterwards. If you send it to me afterwards, we'll get it into the video.
Yeah, I'll send it to you afterwards.
Yeah.
That sounds good. But there's a website that we can send you to that you can fill out the form and it'll mail it to your Congress people. But I'd highly advise that. The more people they hear from, the more people they know support the whole thing and understand why it's important. So make your voices heard.
I don't know if it would be the same study, but I did hear at one point that every real estate transaction pumps about $60,000 into the economy of money to spend, kind of velocity of dollars and cents.
Yeah, right.
So if you did this and people stopped selling because no 1031 exchange, it would have a significant decreased amount of velocity of real estate money. So
absolutely.
Yeah, I mean, really hard to quantify. Definitely not my skill set to quantify that, but in the grand scheme of things, I can see that. So okay, well, we'll wrap this up. Ken, I appreciate it so much. When someone wants to get a hold of you, can you just give them the 1-2 of who do we contact? Sure. Where do we call?
Sure, you bet. Well, our phone number is 515-224-5259, and our website is iowaequityexchange.com. Everything's spelled out. And you'll see our email address. It's at the bottom of every page.
Cool.
Rather than just go there, iowaequityexchange.com.
Cool. And your kids are taking over the business someday. And Andrew, I've emailed back and forth. I'm guessing that was one of the children. So, yeah.
That is right. Yeah, Andrew's my son, and Lindsay Harrelson is my daughter. And we are working through things now to get that accomplished.
We're excited.
Although I'll be around, I expect to be around here for a while.
That's how it goes. Yes. That's good. Okay. Well, I appreciate it, Ken. I'll let you get going. Thanks for joining us on Cinco de Mayo, and hopefully
that's right.
Something planned here a little bit later.
Celebrate responsibly, right? Yeah. Well, Darson, thanks for having us. We sure appreciate it. If there are other questions, people, feel free to get in touch. We'd be happy to visit with you about them.
Will do. Thanks, Ken.
Thank you. Take care. Bye-bye.